At the beginning, everything feels slow. You start investing, you stay consistent, you do what you're supposed to do, and nothing seems to happen. The numbers move, but barely. Progress feels invisible, and over time, doubt starts to build. This is where most people quit, not because the strategy failed, but because the timeline didn't match their expectations. This is the patience gap, the space between effort and visible results. And it's where long-term outcomes are decided. Early on, progress doesn't feel rewarding. You might invest consistently for a year and see only modest growth. 2 years, still underwhelming. 3 years, it starts to feel like something is wrong. But nothing is wrong. You're just operating in the slow phase of compounding. This is the part most people misunderstand. Because growth in investing is not linear, it's exponential, which means the majority of visible results don't show up at the beginning, they show up later. But psychologically, we expect the opposite. We expect effort to produce immediate feedback. We expect consistency to feel rewarding early. When that doesn't happen, we interpret it as failure. And that's where behavior changes. People stop contributing. They withdraw early. They switch strategies. They reset the clock. Not because of logic, but because of discomfort. Now let's look at the math. Imagine investing $400 per month. After the first year, you've contributed $4,800. With modest returns, maybe you're just over $5,000. It doesn't feel significant. After 3 years, you've contributed $14,400. Maybe it grows to around $16,000. Still not life-changing. Now jump forward. At year 10, total contributions reach $48,000. At a steady long-term return, the portfolio might be around $70,000. Now, something starts to shift. Growth is no longer coming mostly from contributions. It's coming from the system itself. By year 20, contributions total $96,000, but the portfolio may exceed $200,000. The majority of that growth didn't come from new money. It came from time. This is the part most people never reach, because they exit during the early phase, when progress feels slow. That's the patience gap. It's not about knowledge, it's about endurance. Now, layer in psychology. Humans are wired for short-term feedback. We respond to visible progress. We stay motivated when results are immediate. But compounding delays that reward. It compresses years of effort into results that appear later. So what feels like stagnation is often just accumulation without visibility. And that creates tension, because it feels like nothing is working, even when everything is. So people look for alternatives, faster strategy, higher returns, more activity. But often, those decisions interrupt the very process that was about to start working. Now, zoom out. Across markets, across decades, one pattern repeats. Those who stay through the quiet phase experience the curve. Those who exit early restart the line. And restarting is expensive, because compounding doesn't reward time spent. It rewards time sustained. Every time you reset, you move back to the slow phase. So, the real advantage isn't timing the market, it's surviving the timeline. This is where identity shifts, from someone seeking quick validation to someone aligned with delayed outcomes, from reacting to short-term signals to trusting long-term structure. Because once you understand the patience gap, you stop expecting early rewards. You stop measuring progress too soon, and instead, you focus on consistency, not because it feels good, but because it works. Over time, something subtle changes. The numbers begin to move faster. The curve becomes visible. The system starts working on its own. And what once felt slow starts to feel inevitable. But only if you stay long enough to see it. That's the difference. Not intelligence, not timing, not even strategy. Just the ability to remain in the system while it's still quiet. Because in the end, wealth doesn't just come from compounding. It comes from outlasting the phase where compounding is hardest to see.